Folks, brace yourselves for a reality check that's about to hit the housing market like a sledgehammer, and it's going to send shockwaves through the stock market. The once red-hot American housing market, which seemed invincible for so long, is now standing at the precipice of a colossal reckoning, and it's going to affect all of us. Just a few years ago, we were basking in the glory of historically low mortgage rates, with the average 30-year rate hovering at a mere 2.65% in January 2021. But fast forward to today, and that rate has skyrocketed to a staggering 7.5%, the highest in over 2 decades. To put it bluntly, this is a bombshell that most people have never seen coming, especially the younger generation who've grown up in an era of low rates. Now, let's break it down for you in simple terms. Rising interest rates and soaring housing prices have formed a toxic cocktail, and it's about to explode. The average American mortgage payment has almost doubled, leaving aspiring homeowners in a tight spot. It's as if the ladder to homeownership has been yanked out from under them. To put this into perspective, consider the golden standard of home affordability set by financial guru Dave Ramsey. To afford a typical $300,000 house, a household would need to earn around $182,000 annually. That's more than what 90% of American families make. The dream of owning a modest home is slipping away for many. For the past 30 years, we've enjoyed an era of falling interest rates, which acted like gravity, pulling home prices higher. But with rates now surging, the dynamics are about to flip. Warren Buffett once famously compared interest to gravity in the finance world: the higher it goes, the less likely prices will keep soaring. Jeremy Grantham, the renowned bubble historian, agrees. He foresees a correction in the housing market due to these rising rates. As he aptly puts it, no one can afford to buy a house now. And it's not just talk, the market is showing early warning signs. The Case-Shiller Index, tracking home prices, dropped nearly 6% in June. But here's the kicker: homebuilder stocks started taking a beating way back in December 2021, a full 6 months before the index reflected the downturn. This is your portal into the near-term future. Homebuilder confidence is plummeting as the rates march towards 8%, and the landscape becomes increasingly unaffordable. Incentives are running dry, and builders will have no choice but to slash prices. This will send shockwaves through the existing housing market, and homeowners may find themselves facing the harsh reality of depreciating home values. So, how will all of this affect stocks? Well, it's a domino effect. As the housing market falters, it will reverberate across the broader economy. Consumer spending may slow down, construction activity could decline, and the overall economic growth may stutter. That, my friends, spells bad news for the stock market. The concerns are clear, but what about potential solutions? It's a tricky situation, but proactive measures can mitigate the fallout. Policymakers should focus on addressing the affordability crisis and providing support to potential homebuyers. This could include initiatives to lower the cost of homeownership and create more affordable housing options. Individuals need to be prudent too. Assess your financial readiness for homeownership, consider alternative housing options like renting, and stay informed about market trends. It's essential to adapt to the changing landscape. In conclusion, the American housing market is standing on shaky ground, and the tremors are already being felt. Rising interest rates and unaffordable homes are driving us towards an inevitable correction. The impact on the stock market is undeniable, and it's a wake-up call for all of us. So, like and subscribe to our channel now. Stay informed, be prepared, and let's navigate these turbulent waters together.